According to DataDash, Bitcoin is trapped in a tight range and a massive move is coming. He calls $71,000 the line in the sand. A weekly close above it could trigger a rally, but staying below it keeps the bears in control. This short-term uncertainty is amplified by macro fears. Crypto Jebb warns that geopolitical tensions and a falling stock market could drag Bitcoin down to the low $50,000 range. He believes this bear market will be shorter and shallower than previous ones. Taking a longer view, CryptoRover uses historical data to predict the real bottom might still be about 100 days away. He's so confident that he's waiting with a $12 million long position set for lower prices. This aligns with Ben Cowen's analysis, who insists the traditional 4-year cycle is far from broken. Ben points to key on-chain metrics that signaled the real market bottom has not yet been reached. So which timeline matters most right now?
In the latest video from DataDash, the host explains that Bitcoin is stuck in a tight consolidation pattern right around the $70,000 mark. He points out that periods of such low volatility usually lead to a big price expansion, meaning a major move could be just around the corner. The big question is whether Bitcoin will act like a risky asset or a safe haven, especially with rising oil prices and global uncertainty. The key level to watch is $71,000, which he calls the line in the sand. As long as Bitcoin stays below this level, there's a good chance it could drop further. However, because it's been consolidating just below this resistance for a while, it might be charging up for a breakout. He cautions that trying to short Bitcoin right now is risky because a lot of traders are already doing it, which could set the stage for a short squeeze if the price pushes above $74,000. It's a game of patience, and a weekly close above $71,000 would be a strong signal for a continued move to the upside. The video also notes that Ethereum and the rest of the market are in a similar holding pattern, waiting for Bitcoin to make its move. The analysis of Bitcoin's consolidation around $70,000 is timely, as the market is indeed at a critical juncture. The speaker's focus on the $71,000 level as a key pivot point aligns with current market observations, where this zone represents a psychological and technical barrier. Recent market data supports the idea of a potential short squeeze, with reports indicating a significant buildup of short positions, which could fuel a rapid upward move if sentiment shifts. The broader economic landscape, including rising oil prices and geopolitical tensions, adds a layer of complexity. These factors are creating uncertainty and influencing whether large investors treat Bitcoin as a risk-on or risk-off asset. While spot ETF outflows have been noted, corporate and whale accumulation continues, suggesting that long-term institutional conviction remains despite the short-term choppiness. The market appears to be in a macro liquidity-driven consolidation phase, waiting for a significant catalyst such as a Federal Reserve policy shift or a major regulatory development to break the current deadlock.
In the latest video from Crypto Jebb channel, the host discusses the major challenges Bitcoin is facing as it hovers around the $74,000 mark. He questions whether Bitcoin can push past this level or if the ongoing war in the Middle East will trigger a significant drop. The analysis points to a connection between Bitcoin's performance and the U.S. equities market, suggesting that if the S&P 500 continues its downward trend, Bitcoin will likely follow. The speaker believes we are in the bear market, but he anticipates it will be much shorter and less severe than previous cycles. He suggests a potential bottom for Bitcoin could form in the low to mid $50,000 range, possibly as early as May or August. Despite the short-term bearish outlook, the video emphasizes that this bear market is fundamentally different, lacking the catastrophic institutional collapses like FTX or Luna that prolonged the last one. The long-term view remains incredibly positive, with a projection that Bitcoin is on a parabolic growth curve that could see its price exceed $200,000 by 2030 and eventually hit $1 million. The video's analysis correctly identifies the strong link between geopolitical events, traditional markets, and Bitcoin's short-term price. Recent events in March 2026 have reinforced this, with escalating tensions in the Middle East causing volatility across all asset classes. While the speaker suggests Bitcoin acts like a tech stock, its role is becoming more complex. It's caught between being a risk-on growth asset and a potential safe haven. The correlation with the S&P 500 remains a key factor, with some data showing a high degree of correlation, suggesting that a downturn in equities would indeed weigh on Bitcoin. However, the video's core thesis that this bear market is fundamentally different holds weight. The institutional landscape has matured significantly. Unlike the last cycle, corporate and ETF-driven accumulation is a powerful force, with reports from early 2026 showing that institutional buying continues to grow, providing a strong demand floor. This underlying institutional demand, which was absent in previous bear markets, supports the idea of a shallower and shorter downturn, even if macro headwinds persist.
In the latest video from CryptoRover channel, the discussion centers on when Bitcoin might finally hit its bottom. Looking back at previous cycles, a bottom typically forms between 780 to 920 days after the halving, which suggests we could see a bottom form in about 100 days from now, around June. The host makes it clear that he doesn't believe the current market structure is a bottom, even if we see some upward bounces. He's patiently waiting with buy orders set for lower prices, including a potential $12 million long position near the range low. The video also touches on Ethereum, pointing out a significant liquidity zone between $1,900 and $1,200, with a key area of interest for buying being around $1,000 to $1,100. Despite the bearish short-term outlook, he mentions it's a great time to accumulate spot Bitcoin, especially since historically, after a drop of over 60% from its all-time high, Bitcoin tends to at least double in price the following year.
In the latest video from Ben Cowen channel, the central argument is that Bitcoin's 4-year cycle is very much alive and well, contrary to popular narratives claiming its demise. Ben points out that market cycle tops have consistently occurred in the fourth quarter of post-halving years, specifically 2013, 2017, and 2021. He presents data showing that the time from the market bottom to the peak has been remarkably consistent, with the last two cycles topping within a week of each other. The idea that the cycle is broken because certain altcoins didn't perform as expected is dismissed as a flawed justification. Instead, he suggests that people's expectations were simply too high. The video also dives into the typical behavior of a bear market, noting that Bitcoin often spends more time trending upwards before experiencing a rapid, sharp decline, which creates a false sense of security for bulls. Historical data for midterm election years 2014, 2018, and 2022 shows a recurring pattern: a low in February, a rally into March, followed by a sell-off. Ben believes several key indicators, like the MVRV score and the price relative to the balance price, suggest that the true bottom for this bear market has not yet been reached. He cautions viewers against those who are now calling for a bottom, especially if they failed to predict the bear market in the first place. Ben Cowen's cyclical analysis, which emphasized a prolonged bear market, proved largely accurate for its time. Looking back from March 2026, the market did find its bottom in late 2022, validating his cautious stance during that period. However, the landscape has evolved significantly since then. The approval of spot Bitcoin ETFs in 2024 introduced a massive wave of institutional capital, fundamentally altering market dynamics. While the core rhythm of the halving-driven cycle persists, its characteristics are changing. For example, the 2025 peak was followed by a less severe drawdown than the historical 80%+ crashes, signaling a maturing market with stronger institutional hands. Currently, the debate has shifted from whether the cycle exists to how it has been reshaped. As of early 2026, after a correction from the 2025 highs, the market shows signs of consolidation rather than a deep bear market, with strong ETF inflows providing consistent buying pressure. This suggests that while the 4-year cadence may still provide a rough map, the institutional presence is dampening volatility and potentially shortening the length and severity of bear phases.
After analyzing 4 perspectives, it's clear the market is at a critical turning point. Across the board, the sentiment is short-term caution. Analysts see the market coiling for a significant move, with widespread agreement that we likely haven't seen the final bottom just yet. The key conflict, however, is the why. Is this a classic repeat of Bitcoin's 4-year cycle, or has the massive influx of institutional ETF money fundamentally changed the rules, paving the way for a shorter, shallower downturn? The unanswered question is whether old cycle maps still work. The key takeaway:
Watch the battle between historical patterns and this new institutional-driven market.